Hi, I'm Mike Capizzola from the Investing Channel, and welcome to IPGo, the show where we take a look at the IPO world, past, present, and future. It's been a rather mixed week in the world of IPOs and new issues as Chinese authorities continue their clampdown on the country's tech giants and startups and their ambitions to list overseas, and in the US in particular. That's a concern not just for investors, but also for bankers who've made a living out of the China overseas listing market, which has generated more than $6.40 billion in fees for them since 2014. There are thought to have been as many as 70 companies based in Hong Kong and China that were considering or preparing for an overseas IPO, many of which would have found their way to US shores. Those deals are now on hold and may not even come to local markets in China, as listing requirements there make the prospect of floating a business far less attractive. However, the Hong Kong IPO market, which has more flexibility, may ultimately benefit from the crackdown. One much anticipated deal that is now in the balance is that of ByteDance, the parent company of video streaming service TikTok. TikTok is the first Chinese brand to really make an impression with Western consumers, and in particular, Gen Zs and millennials. The business had its fair share of problems with the Trump administration, but under the Biden White House, things appear to have been smoothed out. An IPO for ByteDance looked like a genuine possibility this year. However, that seems to be in the balance once more, and there's talk that the deal will be pushed back to 2022 if it goes ahead at all, and that the valuation placed on the business could be dramatically reduced from a purported $450 billion. ByteDance's private equity bankers include SoftBank, Tiger Global, Goldman Sachs, Morgan Stanley, and Sequoia Capital, and as was the case with Ant Group, they could now be holding onto their investment for a while longer, it seems. Speaking of private equity, Bridgepoint, which manages around $32 billion in alternative investments in middle-market companies, has signaled its intention to IPO, but in London rather than New York. Bridgepoint has offices and investments around the globe with a presence in both New York and San Francisco, but has opted for the UK capital for a flotation and will look to raise up to $1.30 billion from any listing. It's thought that the fund manager will offer stock for sale between $4.20 and $4.90 a share, and at the higher end of the valuation, Bridgepoint could be worth as much as $4 billion. The money manager will use the new cash to expand its existing operations, and it's already secured the backing of Fidelity International, T. Rowe Price, and Maurer Investment Management, who, between them, will buy $420 million worth of new shares in the company. Their presence alone should see the deal get away cleanly. However, quoted private equity vehicles are in short supply, so there is likely to be demand from other investors too. Back on home soil, we're starting to see more real business come to the IPO market as the SPAC fad begins to fade. One such business is Phillips Edison & Company, not an energy company as the name might suggest, but a real estate investment trust, or REIT, which owns neighborhood malls and shopping centers that are anchored with leading grocery stores. The business has interest in more than 300 shopping centers covering 31.70 million square feet of retail space in 31 states, which generated revenues of $496.88 million in the last 12 months. Phillips Edison was looking to sell 17 million shares at between $28 and $31 a share. However, the deal was ultimately priced at the lower end of that range. That suggests that it may still be too early for investors to buy back into a brick-and-mortar retail store or landlord. The company will trade under the ticker PECO and will list on the NASDAQ. Elsewhere, Blend Labs, a digital banking and mortgage lending platform founded in 2012, has announced the terms for its IPO, in which it plans to raise $340 million through the sale of 20 million shares at between $16 to $18 a share. No date has been fixed for the issue. However, Blend Labs has retained Goldman Sachs and KeyBank Capital Markets to handle the deal, alongside UBS, Wells Fargo, and others. Like many other banking startups, Blend Labs is not currently profitable, and it lost $74.60 million in 2020 on revenues of $96 million. The company is seeking a valuation of around $4.50 billion, which would put it on price-to-sales multiples of as much as 47 times. And that seems far too high, even for a company that's backed by a half-dozen big-name venture cap funds. As such, it will be a real surprise to us if the deal prices at the high end of the range, or if it sees a first day of trading price bump. That's all we have time for today, but as usual, make sure you do your own due diligence before making any investment decisions.